Lisa Shalett joins us this morning, Morgan Stanley Wealth Management CIO. Lisa, welcome back. It's good to have you again.
Great to see you, Carl.
Got some relief in the benchmark yield. VIX has come off the boil. Is there a growing sense that maybe we have recalibrated here and can afford to breathe a little easier?
I do think we've recalibrated a little bit, and certainly we repriced risk a bit, and the technicals got profoundly oversold, right? So I think that some of the price action and the repositioning that we're seeing in the market, where some of the biggest laggards over the last week are now leading. You mentioned, tech and financials, for example, and I think the market is behaving in the ultra short term in a very rational manner.
Where do you think we stand on earnings revisions? I think the Citi earnings revisions index is negative territory for 17 straight weeks. Are we pricing this in on the earnings front?
We're almost there. I mean, most recently, my colleague Mike Wilson over at MS&Co Research, cut his numbers yesterday. He was one of the holdouts. He's come down from 270 for this year down to 257 next year. He had been at 303, now looking for something closer to 281. If you look at a blend on that, that's still about 270. So at these levels, this market is still selling at a forward PE of, more than 20 times. So, what we've said to people is, don't get too far over your skis. Yes, we've had some repricing. Yes, there are some opportunistic bargains out there that you can reload on. But, let's not forget the context. And the context is that these earnings estimates are coming down, that economic growth is likely to slow. Again, our base case is soft landing, but barely so. We continue to believe that the volatility, does make those recession risks at about 40%. And so, this is not the time, to call the quote unquote all clear, especially with bond market volatility remaining elevated as well.
Yeah, speaking of which, it was only a week ago, Lisa, we were very much focused on the bond market for obvious reasons. Things have calmed. I think 30-year swap spreads right now have calmed down a great deal as well. But we do have a lot of auctions coming up, May in particular. How focused are you going to be on our ability to refinance and do so in a calm market, so to speak?
I'm very concerned. I'm in the camp that says that the bond vigilantes are watching very, very closely here. They're looking at global currency market dynamics. They're looking at the news coming out of the United States Congress on the direction on budgets and the potential size of the deficits. And so, I fundamentally believe we're not at all out of the woods. This is a U.S. Treasury market, I think, that's getting buffeted around, not just by, technicals like the unwind of hedge fund basis trades that I know, Treasury Secretary Besant, has been opining on. But fundamentally, I do think that there are counterparties around the world looking at what is, the right level of cost of capital to be carrying or to demand for long duration U.S. Treasuries.
Well, I guess that's a to be continued on what we see in the price action, little higher yields. My question, Lisa, in the equity market is, what do you do if you're in tariff-exposed names? I'm looking at the underperformance of healthcare, for instance, pharmaceuticals next in the crosshairs, right, when it comes to tariffs. There's the semiconductors, which have gone back and forth. There's retail, which now gets hurt on the China story. How do you deal with that new risk in your portfolio if you own those groups?
Yes. Look, I think that this has, been an extraordinarily, painful set of days, since Liberation Day, quote unquote. But I think if we've learned anything, if investors have learned anything, it's that you cannot count on anything as being permanent here. And so, our strategy has been look for that fundamental value try to understand where are the players here who have very strong market positions, high market shares, can command the pricing power that may be necessary in the event that some of these tariffs hold, and focus on those higher quality names. But we still do very much like the healthcare sector. It is an area that we're looking for some of our stock picking, and that kind of complements our highest conviction area, which has been financials.
That's some good stuff, Lisa. Nice corollary to what we got from Mike yesterday on Squawk. Appreciate it very much, as always,
Absolutely.
Lisa Shalett.